What are index funds? Index funds are a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index. A market index is a basket of stocks or bonds that represents a particular segment of the financial market. Some well-known examples of market indices include the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. Here are some key features of index funds. Passive management. Index funds are passively managed, meaning they aim to mirror the performance of the underlying index rather than actively selecting individual securities. This passive approach often results in lower management fees compared to actively managed funds. Diversification. By tracking an entire market index funds provide investors with instant diversification across a broad range of assets. This diversification helps spread risk and reduces the impact of poor-performing individual securities on the overall fund performance. Low costs. Due to their passive nature, index funds generally have lower expense ratios compared to actively managed funds. The expense ratio is the annual fee charged by the fund to cover operating expenses, and lower expenses can contribute to better long-term returns for investors. Transparency. The composition of the underlying index is typically well known and publicly available. This transparency allows investors to understand which securities are included in the fund and in what proportions. Market performance. Index funds aim to replicate the market performance, so their returns are closely tied to the performance of the underlying index. Investors in index funds are essentially betting on the overall growth or decline of the market, represented by the index. Popular index funds are often associated with broad market indices, like the S&P 500 for U.S. stocks or the MSCI World Index for global stocks. However, there are also index funds that track specific sectors, industries, or asset classes, such as technology, healthcare, or bonds. Investors often choose index funds as a simple and cost-effective way to gain exposure to the broader market, while minimizing the risks associated with individual stock selection. Index funds have gained popularity for several reasons, and many investors find them attractive for the following factors. Low costs. Index funds are known for their low expense ratios. Since they passively track a specific market index, they don't require active management decisions or extensive research, leading to lower operating costs. This cost efficiency is appealing to investors, as it helps maximize their returns over the long term. Diversification. By investing in an index fund, investors gain exposure to a broad range of assets within a specific market or sector. This diversification helps spread risk, reducing the impact of poor-performing individual stocks or bonds on the overall portfolio. It also provides a level of stability compared to investing in individual securities. Consistent performance. Index funds aim to replicate the performance of a market index. While they won't outperform the market, they also won't underperform it significantly. This consistent performance over time is appealing to investors seeking stable returns without the volatility associated with more actively managed funds. Simplicity. Investing in index funds is straightforward. Investors don't need to spend time analyzing individual stocks or making frequent trading decisions. The passive nature of index funds makes them an easy and accessible choice for both novice and experienced investors. Transparency. The composition of the underlying index is usually well known and published, providing transparency about the fund's holdings. Investors can easily track the performance of the index and understand what assets are included in the fund. Long-term investing. Index funds are often recommended for long-term investors who aim to build wealth over time. Their passive approach and low turnover make them suitable for a buy-and-hold strategy, as frequent trading can incur additional costs and taxes. Historical performance. Many index funds, particularly those tracking major indices like the S&P 500, have demonstrated strong historical performance over the long term. This historical success has contributed to the growing popularity of index funds among investors. Tax efficiency. Index funds tend to have lower turnover than actively managed funds, resulting in fewer capital gains distributions. This can lead to greater tax efficiency for investors, as capital gains distributions can have tax implications. The content of this video is not an investment advice and does not constitute any offer or solicitation to offer or recommendation of any investment product. It is for general purposes only and does not take into account your individual needs, investment objectives, and specific financial circumstances.